AI stocks have risen so much. So why do many people still not feel richer? When you open the news, one side says tech giants are reaching new highs, while the other side says ordinary people feel their money buys less. These two pictures look contradictory, but they can both be true at the same time. Let's start with the person on the left. Let's call him the small investor. Every day, he sees headlines like, AI is exploding again, Nvidia is rising again, and data centers are expanding again. But when he opens his own account, his salary has not changed much, while rent, food delivery, insurance, and credit card bills keep getting thicker. So he naturally asks, if the economy is doing so well, why does it feel like it has nothing to do with me? That is the key problem. A rising stock market does not mean everyone becomes richer together. It is more like a party happening upstairs. If you are already upstairs, you hear the music, eat the cake, and watch your account numbers climb. But if you are downstairs, you may only hear the ceiling shaking. The AI boom works the same way. When the market starts believing AI will change the future, money first flows to the easiest places to see. GPU companies, cloud companies, power equipment, data centers, and then upstream links such as HBM, PCB, and liquid cooling. Capital markets price these stories first. But ordinary people's income does not rise just because one company's market value goes up, and it certainly does not rise automatically the next day. This is the first layer of divergence. Asset prices move faster than wages. If your wealth is mainly in stocks, funds, housing, and company equity, the AI boom is more likely to appear on your balance sheet. If your main income comes from wages, what you feel may not be asset appreciation, but living costs rising first. The second layer of divergence is whether you sit in the right part of the supply chain. AI companies are spending a lot of money. They buy chips, rent compute, build power systems, and construct data centers. But this money is not spread evenly to everyone. It flows along the supply chain, first to the scarcest compute links, then to equipment, materials, factories, and engineering services. The closer you are to the bottleneck, the easier it is to have pricing power. The closer you are to ordinary labor and ordinary services, the more likely you are to only feel pressure. So in the same AI era, some people see orders, some people see overtime, some people see stock accounts, and some people see bills. It is not that one world suddenly became better. It is that the same world has been cut into several layers. The third layer of divergence is the time gap between narrative and cash flow. Stock prices buy the future. The market is willing to pay high valuations for AI today because it believes there will be larger profits in the future. But ordinary life is paid for in the present. Rent is due this month. Credit cards are paid this month. And tuition, insurance, and medical expenses do not wait until future profits arrive. So capital markets can celebrate early, while ordinary people still have to settle the bill now. That is why financial news often shows a strange picture. The macro data looks fine. The index looks strong. But the comment section keeps asking, strong for whom? Because an index represents a basket of assets, not everyone's life. When a few giants carry more weight, an index can rise because the leaders rise. That does not mean every company is making money, and it certainly does not mean every household feels easier. Does that mean the AI boom is fake? No. Real demand and wealth divergence can exist at the same time. AI really is driving compute investment, and some companies and supply chain links really are benefiting. But those benefits are not distributed evenly. They are more like water in a pipe. Water first reaches the widest pipe, the biggest valve, and the closest point to the source. The farther away you are, the more likely you are to hear the water without receiving much of it. So, when looking at AI finance, do not ask only one question. Will AI change the world? That question is too big and too vague. A better question is, where does the money flow first? Who has pricing power? Who is only forced to spend more? Whose income actually increases? And who is only watching noisy headlines? If you are an ordinary investor, this logic also matters. Do not assume that every company with the word AI will benefit. Some companies sell the shovels, some companies buy the shovels, and some companies only put the word shovel in their name. When the market is hot, all three may rise, but after the tide goes out, the difference can be huge. Now, back to the opening question. Why can AI stocks be hot, while ordinary people do not feel richer? Because the stock market measures asset prices, while life measures cash flow. People whose assets are rising feel that the era is generous. People whose bills are rising feel that the era is noisy. Both feelings are real. What truly matters is not just the sentence, AI will change the world, but who receives the money from that change. If you stand on the asset side, it looks like opportunity. If you stand on the bill side, it feels like pressure. That is why in the same AI boom, some people see a bull market, while others only see life becoming more expensive.